Okay. I'm going to record on this computer. And we'll go back here. Okay. What was I doing? Internet? Yep. Internet? Yep. So that's basically Los Prados. Oops, I exited out of here. Back to, let me go to here. And go back to Dropbox. I think I am almost done with those. Let's see, Q4. Here. Okay, yeah, so we made it through Corpus, we made it through our Larson, which is our Amarillo project, our Luda May, which is Fort Worth, Los Prados, which is Houston, and then the Meadows. The Meadows, unfortunately, like I mentioned earlier, the platform is still, it's not Juniper Square. I'm trying to remember which this one. It's not Syndication Pro. I'm trying to remember the name of the platform, but it pops up in my email often, where essentially what they're doing is sending this. So I downloaded it and added it to here. And this is the one, like I mentioned, kind of Q1 of the year, we're going to have to go and audit the financials. Some of our refinance information didn't exactly make sense. So, and this is coming from a banker that we brought into this deal. So, so essentially you're seeing what you want to see again is your balance sheet and your profit and loss statement. So again, your balance sheet, you want to compare that balance sheet to your trial balance. And I don't have a trial balance here. Like, as you can see on the tabs, there's no TB, which is typically what we'll have on ours. So on this project, I am not one of the main leads on this deal. And so all I can do is have discussions, be reasonable, get information, right? So a couple of us are looking for some more information on distributions. When are they happening? Why are they not happening at least? And then again, comparing the trial balance to the BS or balance sheet here. So that's one of the most important things to look at. But then the other thing too is to know, so Resman is the backup support software for this. There's Yardi, there's Resman, there's several different property management support softwares. With Resman, in Resman, you can see all the bank accounts that are related to this property, right? So whenever this comes to you, each of those different bank accounts should be listed under the BS or balance sheet. So you can see like the different accounts here. Right here, you can see 11119 or so whatever, the savings in the operating account. The way that I do things, or we normally do things as lead, is we normally have a deposit account, we have a rent account, an operations account, and a CapEx account. And then sometimes there's another, but usually there's 3 or 4 accounts, right? So in my experience, this is not showing all the accounts. So that's another cause for concern that we've had. So all we can do is ask questions. All we can do is get more information. And so we're currently working on that. And being as reasonable as possible to do so. So essentially those are our assets currently in Q4 that we still hold. And then I mentioned what we did cycle through or sell this last year, what those returns look like. It's about, I think, a 1.87 equity multiple or so average. And our low performer was our Denton deal, which is the same operating team as this one right here, the Meadows. So with that being said, that is pretty much all I've got for today. We do have potentially Aliza Zhang jumping in here at 1:30 Central. I have not obviously been in front of my email this whole time, so I don't know if that's going to happen, but here we're going to pause the recording. And if you pop in, just wait until 1:30 Central, and then I'm going to get back on here and see if she's going to pop in. The idea there being is that we just have another female operator who is much more experienced than we are, talking about her 3,000, I think 4,000 units that they have right now, what their plan is for the next year. Really what we're going to do is just continue the same thing. So continue the same criteria, looking for deals that are either distressed because of the market, distressed because of the loan underlying in the deal, distressed because of deferred maintenance and they ran out of money. Or like I mentioned earlier, sometimes things happen where, people that are in the operating team, they get angry at each other and they need to get out of the deal and sell. And so, really just hustling every week to try to stay in the loop on like what's going on out there in the world. So we may have a potential coming up, properties coming up. So right now we're doing our thorough due diligence on the front end on those, and then we'll obviously let you know via email. And then if you're watching this later, what we really would like is if you're interested to send us an actual mailing address. Something we're going to start doing is mailing out postcards to everybody to make sure that when we have a deal, not only is it coming to your inbox, but just in case it goes to spam or whatever it is, that you're also getting a postcard at your house, which would give you information about the deals. The deals are still going to continue to be purchased in our fund model. And what that does is right now it gives you the access to a semi-blind pool fund. And so what that means is right here, if I go to, let's see if this will work. It won't work here. Let's see if I can get this to work. Get mine. That'll work. Okay, so if I go to this link, which basically, so I'll show you how to get here. So I'll copy it. So if you go to our website right here, theapartmentqueen.com, and then you go, oops, wrong one. This is right. Yes, theapartmentqueen.com. Then you go to the top here where we have our menu and you go to the fund, right? So this will pop up right here with a pop-up. And so essentially you'll look at the status of an accredited investor. Are you one? Here's your definition of if you are. If you're not, for everybody else, right? So if you are accredited, you click on the accredited button. It'll take you to the right platform. If you're not, it'll take you to the right platform. So I'm going to go give you an example of the fund, what I mean by semi-blind. Click accredited. And you don't have to go this route if you're not accredited, but it's just the platforms are different. This gives you more information. So essentially, if it'll load, it'll take you to a page right here that will give you access to what is already in this fund. What is the criteria? What do we have to stick inside of? That's the thing that's really important to know. I've had some investors that either don't understand funds or they're afraid of them because they're afraid of it being blind pool. Oh, you can go buy a donkey with it. You know what I mean? And it's like, no, that's not the case. I mean, we could, but I don't know if you guys have been paying attention to like Texas right now. BlackRock, which is a larger version of us, is essentially being investigated by the state of Texas right now because they do the same type of offerings that we do, where they publicly put into the world, hey, here's the buy box of what we have to do. Theirs was related to ESG, so environmental social good, and essentially the percentage metrics and the types of things that they were going to do were never done. And there were cities that were corroborating with them as well to basically say, yeah, we signed off that they did this thing and they never did. So essentially what I'm saying is that it's important to follow and stay in your box because it will come back. So I'm showing you this site because this is probably the easiest place, if you ask me, to understand the summary, what we're doing. You just have to kind of slow down a little bit and go through this. You have to do your due diligence on myself, our team, any other team, it doesn't matter. So we have this publicly available for you to look at. So if you can see here, there's key information, other resources, investment summary, and documents. If you go down into documents, you can see that we have Fund Target 1. So that was the first asset that we bought with the fund. So that was our Amarillo property. And then if you keep going, there's Fund Target 2, that was Corpus. So like we already went through, those are 2 assets that we've invested in. This will give you the operating agreement, the PPM. I believe there's also a webinar and underwriting for each of these assets here. So you can already see what's up, like what did we invest in? And essentially, if you'll look up here under key information, this is where we have to stay in for our buy box. We have to stay in getting you these types of return. We have to stay in this type of purchase price range. We have to stay in this preferred return range. And then we have other, well, I'll skip that. And then also under the investment summary, this is more of a summary. So you're not having to go through the other documents. The full PPMs are there, like 100 pages, you know. If you're not going to go through those, you have to go through this. So what is the fund's objective? What are we going after? Where are we investing? What does a capital call mean in this situation? When we call the capital when you've already subscribed, the fund is going to endeavor to get this kind of return. What are the fees? Everything that, like, what is this thing doing is right here. We also, like I showed you earlier, have that landing page that has this as well. If you don't want to read it, it kind of bullet points it for you, but I just read it, really just read it. So that you can understand what you're getting into. So essentially, it's a semi-blind pool fund. It's only investing into multifamily assets, such as these. In the past, these are literally pictures of the assets I've told you that we've sold off, right? So you can see what we're doing for interiors. You can see this is more of a B-class finish out. And of course, the women. This is our Phoenix deal that had a big fire that we sold it for 3.67x. But just giving you an idea of what before and after, interior before and after, the type of assets that we're investing in. Some people like pictures, but anyway, so you got the pictures of what we're investing into. You've got the actual investment summary of what we're investing into. We've got to stay in that buy box and operate how we have before. But I think moving forward, we're actually going to go bigger. So like, for example, what I was looking at yesterday was 500 units total, and then we're looking at another chunk of the same portfolio with another 500 units, because then we're going to be able to save quite a bit of money on property management fees, on our purchase price for all of our supplies, but basically economies of scale, buying it in bulk. Finally, we've been doing kind of smaller deals, which is funny because 100 units doesn't sound small, but it really is, so we realized to beat our issues with supply chain, to beat our issues with unprofessional management, et cetera, we have to have that scale. So that's where we're going, and this fund is taking us there. So those are the opportunities, and essentially we have it open now. This is again where you're going to go if you are a accredited investor, and you'll click login, create a login, get the verification email in your email, log back in, and then click to invest. If you're not accredited, I'm back at this website. So our apartmentqueen.com, the fund link at the top. And then if you're not accredited, you're clicking non-accredited, and that will then take you over here to our live crowd fund. So this is now open, available. Basically, if you don't meet that definition of accredited, everybody else goes over here. It will cap you at a certain amount that you can invest based on your net worth and liquidity. Reg D does not do that. And you can see the full presentation right here on this page. You can see that we've had the business financials basically audited. It's a review, but so we go through, if you're comparing what was deposited to what it was invested in to essentially anything that we spent or reported, this was a full financial review of all of our bank accounts to prove up that what we said was invested or et cetera was actually deposited and then also spent and invested in the assets. And then also so that the reviews right there publicly, and then the subscription agreements right there. So this also page will give you a full synopsis of like, why are we doing this crowd fund? Why are we wanting to invest with women? Why do we call ourselves the Apartment Queen or Apartment Queen Investments? What's our mission? Where are we going? How can you go there with us? What kind of perks do you get if you invest over a certain amount? What motivated us to get going to do this? So I find that crowd funds, the reason people do them is because they typically are for a purpose. It's not just for profit. And I don't want you to get that confused. We still are making profit, but we also serve a purpose. So then it goes through the actual team. If you're not familiar with crowdfunding, there's a whole hour-long webinar right here embedded in the page that will tell you how crowdfunding works, pros and cons. If you don't understand funds, again, I just went through a little bit about ours, but in general, pros, cons, risks, etc. Our attorney did another hour-long webinar that's embedded into this page on funds, so you can watch that as well. And then if you want to easy invest, there's actually a QR code that you can freaking scan with your phone right here at the bottom, and you can boom, invest from your phone. So this is pretty cool, and I'm pretty excited that we finally got this thing live after 14 months of trying to figure it out. So, sometimes I guess next time I'll go find someone that's done it and partner with them. But anyway, so that's what's going on in our portfolio. That's what's going on with returns. And then this is where we're going next year. Again, working on our growth of our portfolio, because now we have systems and processes. There's a few key roles that we need to bring into the business, which is a operating officer, have that identified, and then basically a project manager to take over my job of going to all the different properties and managing construction projects. If we're going to grow, there's got to be someone for that. So I've got 2 people identified for this. Then also, again, funds. if you're going to open one, are totally different than a Reg D offering, where they require fund administration. They require a financial professional to do these reviews. Otherwise, you have to outsource to a third party, and they're like $3,000 to $20,000, depending on what we're looking at. It's nuts. So we're also vetting right now a company. So I'm sure, like I just mentioned, Juniper Square is an interesting business model. This and Weaver, we're looking at having them come in as our fund administrator, because again, we want to make sure that not only do we have property level financials accounted for, but also we have fund administration covered, so that you all know that essentially our team is releasing ourselves of the liability of doing this incorrectly. And we have a professional organization that is actually insured, looking through, auditing, reviewing the financials, reporting on time, et cetera, et cetera. So that's another fun thing that we get to do. Another fun thing that we get to do when you get into a fund model. It's just a lot more expense for the administration of it, and then also more work. So if you're considering a fund, talk to me, but but it's just is what it is. So now I know. I'm gonna stop sharing and then stop recording, and if we are able to have our guest pop in 20 minutes or so, then I'll let her present. And if not, thank you all for joining today or watching this later on in real time. And I look forward to growing our portfolio with you next year, raising a crap ton more money, because we have to do that to go big. So for imagine we bought 100 units, then we've raised, 5.7 million. Just making that up. That's not correct, but it was like 3 million, right? And then we're going to go buy 500 units. So we have to 5x that raise. Again, just giving you an example. So our investors that are already invested need to invest more. They need to invest more often. And then the reason we have this fund open is so you can invest all the time versus waiting for us to call you to raise money. This is just making it available for you. However, the fund itself will close after a year, and hopefully way before, because what's going to happen is the fund size is 5 million. And it's already raised a little over 1 million in it, right? Once we identify an asset where there's over-ish a $4 million raise, then that fund is a closed-end fund. It does not continue to invest in other parallel funds that we have or other people's funds. It's just like a deal by deal, where you put your money in, it's illiquid. And then all of the deals, however, they all refinance, they all sell, they all distribute money at different times. And essentially the goal here would be to take all of the returns in that fund and to get you your total return you're expecting back faster versus being in a single asset. And then also if you're in like 3 deals or 5 deals in a fund, you get 1 K1 for that versus like 5 K1s that you have to go track down and whatever. So anyway, so we're going to hit pause, stopping share. Stop.
I'm listening to right now, The Creature from Jekyll Island.
We may need to give her sharing access.
Oh, are you listening to it too?
I am.
Which part are you in?
Hey, Elisa, can you hear me?
Okay. Wow, you're further ahead.
Oh, you're connecting to audio.
Yeah, it was like,
Is that not the?
I feel so.
Let me know if you can hear me.
listening to-
Aren't you frustrated? But it's so funny because like, I don't consider myself a conspiracy theorist, but I also.
They cannot hear you yet. Connect out.
I don't take things at face value, like
Yeah.
what they are, right, like whatever's presented to me.
All right, Lisa, can you hear me?
Information.
Yes,
Hi, happy holidays.
thank you.
Good to see you. So we've got a couple investors here in the Plano location that we're located at. The online investors pretty much just said they want the recording. So if you just want to update everyone, what I really wanted to do was kind of show our investors, in performance of investments. What's your strategy going forward next year? What you had to adjust this last year to pivot maybe. And just overall performance. Like we went through our nitty gritty like numbers. You don't have to do that. But really just to give us like a taste of where we're going and another female that we can invest with.
Okay, oh, sounds good.
You know what I mean? So.
Do you need sharing privileges?
I don't think so. I didn't have any numbers and etc. to share right now. So it'd probably be more stay on the high level per se. I think the one thing I do want to kind of note is switching up the property management and then certain things that we have to deal with during this year. So it's not all green fields and fields. Yeah.
Same. We're like, oh, elevator down, fire, yeah.
Yeah, exactly.
And screenshot that.
We're talking about meditating over here.
Good.
Yeah, I want to
Good.
know that too. Mine was Joe Dispenza's, the unlearn the habit of being yourself. It's like science. And then you're like, oh, I understand molecularly what's happening. And then it's like, here's your step process to like meditate.
That's kind of how
Nice.
Happy Feelings, have you read that one?
Mm-mm.
That's a lot of science. He talks about your lizard brain and everything else.
Lizard brain.
Yes. Oh my gosh, that was a really good book.
Already?
Mhm.
All right. Have a background on. I
Do you want
lost
me to put a background on here? I can. Let me
Yeah.
go. Let's. No, I do have a virtual background, which would be good.
the one I have on my background is a deal that we lost. I kept being like, I just need to see it. The commerce deal. It's okay, it'll come back.
I was gonna say, you did not go down easily on that one.
No.
So are you like alive over there with investors, or are they mostly
Yeah.
online?
We have the ability to get in on Zoom because we have a lot of investors that come from Houston. And so they're like, I'm not driving to Dallas. And then we have some that are local here. So basically this is recorded for those that didn't pop in during this time. And then we have a couple that are here.
Okay, cool.
So how did it go for you, Elisa, this last year? What did you have to pivot on and what is your strategy going forward?
Yeah, so this year has not been a very easy year. We actually also in the midst of an acquisition, we have to adjust our acquisition goal. So we ended up a year purchasing about $275 million AUM versus our original goal of about a 400 million. But again, when the market changes, we have to kind of adjust and pivot ourselves. We also had a few challenges during the operation as well, due to, you know, rate caps and etc. In our earlier deal, we were able to kind of be ahead of everybody and bought rate caps that is at like 25 base point before the rates all went up. Now it's obviously not affordable. So later on, we have to adjust that to actually the late deals that we bought, where one of them is not on rate cap at all, but instead we have raised more for the reserves. So because you're facing with the challenges of you're spending $3 million to buy a rate cap that is like 2% or 3%, that would not even be kicked in by now, versus having a $2 or $3 million into the reserves instead. So that was something that we negotiated with the lenders on, but it's still very much a nail biting exercise. You know, up to this point, it's still the right decision, but I think with the rates keep on going up, there is also unknowns in that, right? So so it's a really kind of hedging your bets against certain things that is not in your control. So all we can do is make the best decision we can at the time. So yeah, so some of the rate caps that we have placed last year on our early acquisition, you know, when everybody else weren't placing the rate caps, they're actually really paying off. Because with a 25 base point of rate caps right now, these policy I didn't know until now actually has its own value on resale values. So there are more strategy you can kind of do with them, such as, you know, potentially trade it if your rate caps are coming due soon. You can probably trade it for a longer rate cap, a higher percentage rate cap. So just to kind of help you hedge against the future anomalies that happens because nobody knows where the rates are actually going. And or you know, somewhat the properties that when you look at it, be like, okay, I wanted to hold this for a long time, but I still would be making a profit for the investor. So do you just kind of take the chips off the table, even though the investor may say not the right time to sell the property? But it is the right time if you actually has exceed your performer or hitting your performer in a much shorter period of time. So your IRR is a lot bigger versus when not. So these are some acquisition adjustment that we have to kind of make Operation wise, it's been a very challenging year for us. I would say, again, I like to kind of share, hey, everything is all great. We're doing a fantastic job. But as any challenges, there's operation wise, we have been facing a lot of big challenges.
Yep.
One particular one that we actually had challenges with our property manager, specifically this year. One of them is actually local in the Texas market. You can follow up off the line with us on who that
Yeah,
is.
please.
That we but I don't think they're in business anymore. But basically, we actually had a fraudulent case against us from the owner of the company, which is something that you would never guess. And then the structure has set it up with them incentivized for them to work harder because the owner is actually part of the group as well, like part of the general partner. So you would think, hey, we give you a share, you would treat this as your own property. Very, I think it's a very sound structure. However, I think the selection of the partners, it's first set up partner we worked with them on. We did background checks on everything, but somewhere halfway through the year, that integrity is not there. So we
I
were
hear
able to
Dealt with that
really,
before.
yeah, we were able to kind of really quickly, well, this is actually more of a criminal case. So we Ashley was able to kind of recover for our investors by garnishing the general partner shares that we have given out, and also garnishing the LP shares that he has purchased using his acquisition fees. And the extent of fraudulent activity is quite extensive in terms of the sophistication of the operations there. So we were able to kind of get out of that, actually came out a little bit more positive because we were able to kind of garnishing these GP shares and et cetera. And we caught the issue early and we took some really proactive actions on this by informing, keeping the lender to very transparent and working with the lender to essentially remove the access for bank accounts and et cetera from this person. And I thank you, my partners, for this as well. So we're able to kind of proactively, stop the loss right away. And it did took us down, it was about 250K of money was stolen from us. But we were able to recover from the equity, but it does provide a little bit of a cash management issue for us because that is supposed to be the funding that goes and operate a deal. We kept as reserves, right? So, that's a pretty big chunk of money that went out. We're able to recover in the form of equity, but not cash flow. So we have to hold the distribution for our investor to build that cash flow back up again. Now it's build it back up. So we're starting to redoing the distribution, so resuming the distribution and have a plan to catch that up. So these are just some of the challenges we deal with that maybe not to do with the market. And later half of the year, the interest rate increases, even though deals that we have rate cap at 2 or 3%, or anywhere between 1.5% to 3%, the deal becomes a lot more challenging to operate. And then that's when we need to have more proactive communications with our investors and making sure everybody knows. Literally, like if you sign up your loan at a 3.5% rate, and if your interest rate has gone up 2% or 3%, that almost doubled your mortgages. So a lot of these performance are kind of out of the window.
Yeah.
To some extent. However, I would say this as investors, people should not panic about that environment. Because the key over here, and we're probably going to see some cash calls coming our ways too. Most of our deals are okay. But we may be contemplating doing one cash call on the deals and whatnot. I'm sharing all the not so rosy stuff over here, it has some positive stuff too. But when that comes as investors, and when you're facing with this, it's like, look, if there's a $20 million deal or a $60 million deal and you need an injection of the $2 million money for cash flow and managing it to go through the low period points, the interest rate is going to drop and the market will recover. And what you don't want to do is to try to sell the properties and take a loss during that time. Same concept with the stock, right? So it's very hard to stomach on this. However, I think when you're facing these challenges, that you have to kind of think about this reasonably. Now, on the great side, we do also still have deals that went full cycle and still hitting, 40%, 50% IRRs, because they were bought, right? And they were bought a couple years ago. As the cycle kind of goes up, you sell them and you're still riding that high, even though it comes down a little bit, it still makes sense to sell them. Because like I mentioned before, you have way outperformed the performance. And by the way, we only do projections on like 13% IRR on our deals, but in the actual outcomes of the deal, nothing ever happened as a planned, so the cash flow element is actually very unstable. The way we kind of look at it, because a lot of folks will say, hey, at least in the markets that we invested in, right? Like a tier 2 markets, these are kind of full cycle markets going up and down. Realistically, if you underwrite a deal properly, the deal shouldn't cash flow from the first, well, it will cash flow a little bit, but not down to like 7, 8, 9% until a couple years later when you actually stabilize the property. So we want to make sure that we, right. And then we have, in our investor webinars, we have kind of set these expectations up in the
That's the way
front.
we do it. Yep. Yep.
But there is the preferred rate, and also there's the actual rate. What the investor get on the preferred rate, we always really clear in our presentations. Like, even though if you're getting a preferred rate at 7% accumulative, it just means the general partner doesn't get paid until your 7% accumulative have been met, which
Yep.
means your stack is being prioritized versus the general partner's stack, right? Which may mean the first 1-2 years, you may be at 2%, 3%, 4% interest, like basically return rate on that. But it start to going up later on. And with the market shortages, that margin is pretty thin with the cash flowing, but you want to make sure the asset actually have the right reserve, the right amount of reserve, the right amount of mitigations on it, so that you can write out the lows when you can, in a way to kind of preserving your asset. We kind of have always underwritten our deals under these consumptions, like assumptions, with rent escalators being really, really low, like a 2 or 3% in Dallas and Phoenix hot market, even though rent increases has been double digits a year over year. So these are kind of like some of our ability to exit our deals this year, going full cycle and still hitting average over 40% IRR rates for our investors, right? So that's, deals are still made, money is still being made. And then I think deals that bought earlier this year and then later last year, and we did bought quite a bit of these, they're gonna have a little bit more challenging. We are changing our acquisition strategies on this by changing, halfway through it, by changing into fixed rate debt. And then doing a fixed rate debt and secondary mezz piece that's also fixed rate. So the blended rate is, at 6.5%, 7.5%, which is still a very good rate compared to the interest rate now, but except that they're fixed, right? So that's a lot more stable in terms of the bridge loan. And with current environment, the bridge loans are not really giving you more leverages. So there's not really a lot of advantage of that bridge loan versus fixed rate debt. I do know operator continue to operate with bridge loans. And then we do on some smaller deals. On the smaller deals, you can actually get fixed rate bridge loans, which is kind of neat, because it gives you a little bit of higher leverage. The interest rates are pretty high, at a 7%. Right now, I don't even know. Probably 8% or something like that. But if your underwriting kind of makes sense and make it work, I have a really small deal, just my personal ownership of a 10 unit. I wouldn't put investor on that type of a roller coaster ride. But basically we invested into that. The plan is to renovate, as many units as possible. And just to know, this is also in Seattle, so I do not put investors' money in the Seattle deals, but I live in Seattle, so it's really my personal holding. There's a lot of risk going into it. One of them being like it take us a whole year to evict a hoarder that is in one of the units. So that's basically rendered unusable. However, that person's out finally. Thank you for my assistant for that. But you know, like we kind of looking at the deal and then we're able to kind of exit that deal very quickly. So with the 8% rate of interest, a fixed that interest, you can kind of still writing it out and get a lot of equities on top of it. We'll probably be looking at a double of a return in about a year time too, right? So that's like the stuff that you have to look at, and then making sure that the business makes sense and there's a proven track record on the value added business that you have been doing, and then it's showing the results for that. And I think overall, I would say the whole lesson learned that I have over here is your property manager is really your biggest partner. You can have a property manager that has performed for you, which is our case in our Phoenix property. And we're actually in the midst of changing property manager starting from January 1st. We're going to have a different set. We actually contemplated taking in-house on this one as well.
Yeah.
We noticed the performance are start tanking for our larger properties, for our Phoenix deals, and has a lot to do with the property management. So really try to solve the problem. But there are certain jurisdictions that you can't cross, such as hiring criteria and all the other stuff, unless if you kind of get all your hands dirty with that, right?
Yeah.
And at that point, you're running kind of your own property management company. But there's such a learning for us. So there's a short window stinch, about 2 months time, that we actually hired our own people. We kind of cleaned the house. We were on the track to do a self-management. However, it was very smart for my team to identify, we would have probably spent the next whole year to build up a new company with property management. Likely not the best decision for our investor, but we only did that because it was so hard to find a alternative third party that checks all our criteria boxes, right? And finally, one person suggested one company, and actually everything just adds up. So we're like, wow, like this unicorn actually existed. And then we're gonna give it a try now, right? So that was a huge relief when we actually switched it back to a third party manager after 2 months, kind of like doing this hybrid mode. Because the self-management, that's going to be a trend in the industry. And I think the reason why we want to gravitate towards that is you pivot a lot faster. But this can be also achieved if you're working with a boutique property management company that actually has full cycle track records, with institutional grades investment. And that's very hard to find. And somehow we found it. It was actually from a previous seller that we bought a couple properties from, so we have kind of firsthand experience with how their management look like, because you get that during the transaction and you get that after you take it over, look at the books, look at the records and all the other stuff. So not to mention, I actually hired an employee from them as my senior regional, who's going to be my number one person that oversees my portfolio. So it's that employee I kind of brought it up. Actually, there's a company that fits all your check boxes. It was my past employer, which is a very weird conversation. But it was a high integrity on this employees, because there's nothing that she's gaining from the going back part. But she's I can sacrifice myself going back, and making that relationship happen. So we're pretty excited for this new management, but we learn better. And I think and my current management that we're transitioning out from, they did well on our full cycle deal. They helped us with full cycle deals, right? But as we kind of grow pretty rapidly, they couldn't keep up with the growth.
Right.
So it's a function of the growth that is causing some of the issues over there, in terms of couldn't hire fast enough, it didn't have a system in place. These just become so much more bare. And then when you selecting a property management company, you have to look at that and you have to share your growth trajectory.
Yeah, I mean, that's right. That's one of the biggest things that I see coming.